Good morning and welcome to this week's Ben's Market Insights. Again, this is becoming the fifth week of weakness in stock markets and risk assets. We're going to talk about the fact that the panic is continuing, the war continues, central banks are on hold, and the inflation threats are looming large. In terms of market specifics, we'll have a look at potentially Meta's tobacco moment. Are the Mag 7 going ex growth? And we'll look at some market technicals, including the put-call ratios. So let's think about this sort of risk asset issue. But before we do that, if you're enjoying this content, please subscribe to our YouTube channel, Ben's Market Chat. Give us a thumbs up and a like. Thank you very much. So there is no clean end in sight for this Iran war. The S&P is now in correction territory. Nasdaq has been in correction territory since the beginning of last week. The S&P has also broken a very important 200-day moving average. That normally results in further weakness, just to keep that in mind. The market, however, or at least investors, still believe that the war is a relatively short exercise. If we look at the December Brent for 2026, we're looking at an $85 handle compared to the current spot rate above $115. So there is still an expectation this is a relatively short-lived exercise. The other interesting part is that clearly technology and Mag 7 have taken the brunt of the hit so far this year. The S&P500 cap-weighted index, as I say, is down in correction territory, but the equal weight is barely 1.5% off. So there's certainly been a rotation towards energy, industrials, and staples, which is something you'd expect in this kind of defensive-like environment. Interest rates, again, investors are now believing that potentially we have no further rate reductions, but potentially a rate hike. I don't see that coming. However, we do have the 10-year US Treasury at 4.4%. The last time we got to above 4.5%, that spooked the administration, and that was the time around the tariff period. That spooked the administration into backing away from implementing the harsh end of those tariff numbers. So we're heading back towards that 4.5% threshold, and that may well decide the administration's efforts in the Iran war. So it's less about geopolitical wartime strategy and more about how the financial market might take a further incursion, certainly from a ground perspective, into Iran. In terms of the core inflation numbers that the Fed looks at, we had PCE expectations from the Fed, who have now raised those numbers for 2026 to 2.7% from the 2.4%, reflecting the oil price shock, which we can call that now. And the OECD has cut global growth for the same reasons for 2026 to 2.9% from above 3%, and added that the UK is the worst hit of the G20 countries. We still have comments from the administration that the straits of Hormuz are allowing some ships. These are a handful. Just to keep in mind that the straits ahead of the war were seeing some 138 ships on average per day going through. And as I say, now it's virtually zero. So in a macro perspective, I think that we are heading into a period of time where potentially the administration is now souring to this, what looks like an elongated war. They want those off-ramps. They're talking about those off-ramps. Financial markets aren't helping them. Anything above 4.5%, potentially 4.6% on the 10-year Treasury is certainly going to spook the administration into some kind of definitive decision to pull away. And that is one thing that I am very concerned about, is that there won't be potentially any kind of resolution to this war. It's just that the US will argue that it has met its objectives and move away. And that means that there is no resolution from a Strait of Hormuz basis. Potentially Iran keeps that as their wild card, as their joker, if you like, in their pack, and use that as the weapon to essentially batter the global economy, with the US deciding it's no longer their concern. That, I think, is a very messy outcome, and it's an outcome that is becoming more and more likely in my view. Let's move to the micro markets or micro part of the marketplace. And think around Meta. Clearly all the Mag 7 bar Apple have suffered significantly over the last week. Meta is down some 14% this week, largely thanks to a couple of court cases, which we'll come to. This is not to do, and I think the initial impression was that Meta would be immune to some extent from these court cases, as there is an element called Section 230 of the Communications Decency Act of 1996, which would provide for immunity to online platforms, protecting them from effectively liability for content posted by their users. But this is not what this is about. The New Mexico court has fined $375 million, which is a drop in the ocean for Meta's cash flow generation. That's not the point. The point is that it's suggesting that Meta has failed to protect kids from predators. And California has also made Meta and YouTube, i.e. Google, liable for $4.2 million. Again, not a major sum, but potentially a precedent for using their algorithms to effectively create addictive features that make people stay on the sites. Under 18s account for about 10% of Meta's users on Instagram and Facebook. And the kids under 13, which is probably where this is really directed at, are around 4 to 5%. I'm not suggesting that this is something that we should ignore. Certainly not. It does change the profile to some extent of how these businesses need to operate. I suspect that further bans, restrictions, age verifications need to be in place and need to prove that they are able to keep kids away from their platforms. From a revenue perspective, this is not, I think, a major factor as yet. I don't think that cohort of the 5 to 10% are particularly important from a monetization perspective, particularly from an advertiser's point of view. I don't think advertisers are going to abandon Meta or Google, YouTube, and all the various social media platforms simply because it's become their only genuine option to reach their marketplace. Social media is a complex arena. It can certainly have harmful effects and addictive effects and mental health issues that come from that. But it's also a very popular form of communication and media. It is where many billions of people around the world use to acquire their content and their news. So there are good and bad elements from social media. I'm not here to suggest that this is a place where it should be protected. I think that vulnerable folks should absolutely be protected and that these companies need to raise their standards to be able to do that. My point here is that from a revenue perspective and the potential to lose advertisers, I don't think we're there just yet. In Meta's case, they've also suffered from this idea that they're potentially losers in the AI game. Llama, which is an open source LLM, is not as good as the market participants today, the likes of ChatGPT or Claude or others. However, this is really not, for me, the case. The issue here is more that Meta is a beneficiary of AI development, being able to target their consumers far, far better using pattern recognition and thereby increasing the return opportunity for their advertiser clients. And then finally, I would suggest that the multiples now that we see Meta has come down to is less than the market. It's around 16 times forward earnings with similar earnings growth rate, which in both cases is certainly better than the S&P 500. So from a value perspective, we're beginning to look very interesting here. The next part is really around, is overall, are the Mag 7 stocks going X growth given their performance year to date? The answer is a definitive no at this juncture. There are no real companies that are coming up to really compete with these businesses at this juncture. The authorities are not really getting too involved in closing down or reducing margins in these businesses, despite what we've just said. So strong cash generation, still AI is their growth opportunity going forward. It is CapEx investment time. It is CapEx heavy today, but those returns, I suspect, should start to accrue from 2028 onwards. There are major protective moats for these businesses. They have got pricing power, and even a long-term weak dollar, which is what this administration wants to see, is good for them in terms of their international business. And so I would suggest that the mega tech stocks are probably oversold at this juncture, but that does not deter from the fact that we are in very murky territory, and standing on the sidelines is probably not a completely bad idea. And with that in mind, let's talk a little bit about the Nasdaq put-call ratio. This is the level of puts versus calls on the market. Obviously, puts are a negative sentiment indicator, calls are a positive sentiment indicator. The put-call ratio is currently at 1.3. The worst it got to in comparative in contemporary times is around the 22 sell-off, where it went to 2.3. It is worth noting on the bullish side that subsequent rally was about 55% for the Nasdaq thereafter, but it certainly would suggest that the 1.3 level that we're at now is not in capitulation territory, and further weakness may well ensue. It's also worth keeping in mind that the genuine big-time outperformers have been the energy, defense, and some of the financials. And these are stocks that are now trading as if they were mega cap tech stocks in terms of valuations and performances, but they don't carry those structural benefits, the structural cycle growth benefits. So if a reversal does occur in those sectors, then I suspect that we are seeing a market heading much lower. But if there's a rotation back towards those Max 7 stocks, we potentially actually might even see markets recovering from these levels. When that happens, it's hard to tell, but certainly we are still in murky waters. Stay safe.